Inflation doesn't hit everyone equally. It quietly rewards some people and it secretly destroys others. Now, inflation, a lot of people think it's just prices getting more expensive when the reality is a little bit different. Now, inflation really is a wealth transfer mechanism. Now, we're going to unpack how wealth gets transferred with inflation in this episode, who it benefits, and who it secretly destroys in this episode. If you get some value out of it and you're looking for more property investing content specifically related to Australia, that's what we do here every single week. If that's of interest, consider subscribing. If you're new, my name is Nick V. I'm the founder and director of the Smash Property Investing Buyers Agency, where we help property investors build and scale property portfolios. Now, let's get straight into this episode. I want to talk about, firstly, what inflation actually is, and not just the textbook version of it, right? Like, what is it out there in the real world? Now, as I just mentioned, inflation isn't just prices going up. Now, the reality of it is inflation is money buying less. It's an important distinction to make, and I'm going to explain further in this episode about how we can sort of wrap our heads around that. So as money supply expands, purchasing power shrinks. So there's more money, we can buy less things with the money. So the asset prices that we use money to go and buy seem like they're getting more expensive, but it really is, you just need more money to go and buy the thing. So we'll talk about who benefits from these asset prices, inflation, getting more expensive, and ultimately who benefits from inflation and how you can make sure you don't get yourself screwed over as well. So how does wealth transfer happen during inflation? Let's talk about this. Now, one of the cool things that really hit me probably in the last maybe 5 to 10 years when I really started to understand inflation and its relationship to debt and asset prices and all that sort of thing. Now, as inflation occurs, debt gets smaller in real terms. So, like, as an example, you might have, let's call it $1 million worth of debt today, okay? You might not pay down any of that debt. Let's say hypothetically you didn't pay down any of that debt for 10, 20 years, whatever it is, right? As an example, you'll still have the $1 million worth of debt, but the value of the money you're using to pay down that debt 10, 20 years from now is worth less. You need more of it to pay the same debt, which means your debt has now been eroded by inflation. I hope that makes sense. We're going to talk a little bit more about that to make sure it does make sense for you guys. So inflation really just reduces the real value of debt over time. It might take some time for that to kind of sink in, as it kind of did for me when I first sort of started to understand a little bit more about this. But that's why when people sort of get fearful of debt, I sort of look at it and go, okay, if you've got debt that's tied to an income producing asset, you should be happy because inflation occurs, your debt is just getting eroded away, right? So you think about maybe just rewind and go, okay, you know, our parents and our grandparents had bought properties for, I don't know, 10, 20, 30, 40, $50,000, whatever it is that, you know, 30, 40, 50 years ago, right? They would have had massive amounts of debt. Interest rates were really high. It would have just been absolutely stressful to have, right? Let's say they were, you know, had instruments back then when you could just do interest only. I don't know if interest only was even allowed back then, but let's say hypothetically it was, and you still had that $30,000 debt today tied to a house that was now worth $1.5 million. You see my point? It's inflation doing its thing. That's probably the greatest example of what I could give you of how inflation affects asset prices and how inflation affects debt. So as asset prices, I'm going to call it repricing because it's not like they're getting more expensive, okay? It's just the value of the asset is repriced against the currency needed to go and purchase it. So the replacement cost of the asset rises. So think cost of building, as we've seen inflation over the last few years, has gone up because the materials used to go and build the building have gotten more expensive. So the replacement cost of the building over time is going to get more expensive. So if you've already got a building, right, and you've bought it below replacement cost, and you've got a debt tied to it, and you've got a tenant in there, your asset is going to, over time, it is going to reprice itself, and you are going to be the ultimate beneficiary of that. And it's not just property. I'm a property guy, so all my examples kind of automatically relate to property. But gold is another good example. Go and have a look at the gold price history against inflation, and you will see the gold price just follows inflation. Very, very interesting. That being said, the, I guess, non-beneficiary of inflation is wages. Okay, so incomes adjust extraordinarily slowly over time, right? So assets, like I said, get repriced against the currency needed to go and use it. Your wages probably going up, if at all, 1%, 2%, 3%, maybe if you're lucky 5%, maybe if you're absolutely balling and killing it, a little bit more than that. But the reality is the income that we go and earn through a job is only updated very, very slowly for the large majority of people. I know there's some ballers out there that would have, massive amounts of bonuses and all that sort of stuff, but the large majority of people, wages go very, very slowly. Now, if we're going to earn money from a job and we're going to go and save, a couple of things are happening, right? The income that we're earning is only going up, if at all, very, 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 very slowly. The savings that we have, the value of that savings, whilst the number might be the same, we've got $10,000, we've got $50,000, that number's going to stay the same. But what you can do with that next year is going to be slightly less, which does hurt and does sting a little bit, particularly if this is kind of like a new concept to you. But I'm going to tell you how you can kind of reverse that in your favor. Like you can tip the benefit all in your favor. I'll talk to you about that in just a second. Excuse me. So let's have a chat about who inflation quietly rewards. So inflation quietly rewards asset owners. So what I mean by an asset, I typically like to look at income producing assets. So outside of property, shares are a great example. An ETF tracking the top 200 companies in a market, great example, right? Because it is a asset that you have that is tied to companies that are going to be rising in value or repricing against currency used to go and purchase the asset. And they typically can pay dividend as well, right? Which is the income that you can get from it. So an amazing thing to have. Bonds are another thing. Typically not going to pay out as higher amount as a property or an ETF or a stock. Those types of assets. I know there's crypto. I'm not a crypto bro, so I don't really get it, to be honest. Let me know what crypto is in the comments. No, I'm just kidding. So asset owners are typically rewarded by having the assets in their name or having control of the assets through an entity. Now, people with long-term manageable debt are the secret beneficiaries of inflation. Like I mentioned in the intro or at the start, like if you've got a debt, ultimately that's tied to an income producing asset, even if you had a debt that was a car loan, never encourage you to do that. I did that when I was younger. It just destroys you financially. No, and that's not the right word. It doesn't destroy you. It just holds you back a lot, right? So if you had a debt tied to a property, over time, that debt is going to stay the same if you have interest only, and it is just going to be eroded by inflation, which is amazing, right? Because then we can go, 100,000 today was very different to 100,000 10, 15, 20 years ago in terms of income. All right. And a lot of people are earning $100,000. It's maybe not quite the average income from Australia, but the average income has slowly increased over time thanks to inflation. We're using that inflated currency to go and pay down the debt that we took out 10, 15, 20 years ago. We are beneficiaries of inflation. Now, if you've got an income that adjusts with inflation, so think our toll companies, right? The toll CPI increases, right? The toll increases with inflation. It's directly pegged with it. So the toll company is doing very, very well from inflation, and maybe you might have an income tied to inflation. If so, kudos to you. Let me know what income you have if it is tied to inflation in the comments below. Now, this is important. You know, I'm talking about assets, and I'm talking about incomes tied to inflation, all this type of stuff. You might be going, yeah, Nick, well, I'm a teacher, I'm a doctor, I'm a lawyer, I work in the bank, whatever it is. This is not about being rich. Don't mistake having assets with being rich. This is just about positioning yourself so that you can put yourself in the bucket of being a beneficiary of inflation. So I've done a couple of shorts on this recently, but precious metals, right? If you have a couple $1,000s lying around, you can go out and you can buy gold, physical gold and silver, right? That is going to, it's not an investment, right? But it is going to maintain your purchasing power. So instead of having $1,000 sitting around, you can have $1,000 worth of gold today that will inflate with the currency over time, right? If you maybe got a bit more than that, you can obviously get into an ETF, or if you've got enough, you can get into property. This is not about being loaded and like, oh, it's only the wealthy that benefit. We've all got to start somewhere, and it's just about slowly building yourself up over time. The first investment I made, I bought an ounce of gold 10 years ago maybe, right? And I remember at the time I was like, oh shit, I think it was like 12 to $1,700, somewhere about that price. And I remember thinking like, man, I really need this money, but I'm like, I don't know what happened in my head. I just forced myself to go and buy the gold, and I quickly forgot about the $1,500, whatever it was. And now 10 years later, I wasn't even following the price of gold. Now I looked at it, I'm like, shit, like, I'm so glad I did that, because I think now an ounce of gold is, correct me if I'm wrong, I don't know, in the I'm going to say that's a kilo of silver is about $4,000, 400 bit thousand. It's a lot. I think it might be close to 4, 5, 6 grand, something like that. Don't quote me. I don't follow the price religiously, right? It's just, I just had it, kept it, and it really hit me. I was like, shit, okay, I've preserved my purchasing power here, right? So like the point being is, you don't feel like you need to have hundreds and hundreds of thousands of dollars to be able to leverage this in your favor. Now, I just want to pivot on who inflation punishes, and it punishes people consistently that are saving and holding onto large cash balances. Now, I know we're going to always have to save for something, but when you have saved for the something, go and buy the something. Ideally, it's an asset that we're just talking about. Because if you're just sitting on $100, $200 plus $1,000, whatever it is, every single year, that value of money is getting less and less, or the things you can do with it are getting less and less. So as soon as you've got the capital to go and do the thing, go and do the thing. If you're on a fixed income, and not many people might be, or two fixed industries might be, but fixed income earners obviously getting punished, because if your income is just like static at $100,000, you might be like, yeah, cool, I got a contract for $100,000 for the next 5 years. That is going to be punishing you year after year. You know, the $100,000 in year 5, the stuff that you're going to be able to do with that is a lot less than year 1. And apologies if this might be simple for some of you, but I just want to cover all these basics, because I know a lot of the viewers are new to investing, new to doing this sort of stuff. But I think it's important we kind of just make sure we're on the same page with this, right? So ultimately, like, doing nothing, like if you're sitting there saving, you're like, oh, cool, I'm comfortable, I've got, $100,000 in the bank, like I'm good, like I'm safe, I'm protected. That might feel safe for you or for a lot of people, but ultimately that is like the most expensive decision, because of all the reasons I just mentioned, right? Like, what is that holding? You might as well go and buy $100,000 worth of gold, right? Because you can offload gold pretty quickly. And then next year, the value of that gold, you say you bought 100 grand worth of gold now, next year the value of that gold might be like 110,000, as opposed to you might have not have bought the gold, you got 100 grand in your account, but a year later you can only do $90,000 worth of things with it. Hopefully that makes sense. Okay. So let me talk about property. All right. Let me link this to property. Again, I'm a property guy. I'm a property investor first and foremost. And I obviously now help people buy property. So not financial advice. There's no guarantees with anything in this world, but why property is kind of, in my opinion, a good middle ground for investing, and a good middle ground in terms of return, good middle ground in terms of risk, volatility, all those sorts of things. Because I know full well there are lots of investments which will take property to the cleaners in terms of what return you can get. With that, as always, higher return, higher risk. So property is not some magic thing that we get in the market and we're all rich, we're all wealthy. You can still make bad decisions. Absolutely. You can still get it wrong. You have to really get it wrong in property, but you still can. I see it quite a lot, particularly with, and it's not so much, you might think, okay, well, it's I don't want to buy in a bad area. It's people that get it wrong with property get sucked into, I'm going to call it schemes, man. Like NDIS, buying brand new because your accountant said you need depreciation, co-living. I see people all the time with this co-living get absolutely stung, and it stings because I'm like, it ain't that hard, man. Like, just go and buy a property in a capital city and you'll be good, or a large regional center and you'll be good, or even a medium-sized regional center and you'll be all right. Just don't do the weird, exotic stuff, all right? So property can only help you if you have cash flow from the property that works for you. And I'm not saying it's got to be positive cash flow, but it's just got to be enough for you to be comfortable that you can service the loan and debt over time. You've got to be able to survive the debt, right? And particularly in the beginning, the first 5 years is typically the hardest when it comes to holding a property and you needing to input some of your own cash to balance that out. It really only benefits you with property if you've got a good quality asset. It doesn't mean to say you've got to be in a good area. I'm just saying an asset where you're not having to tip money into it all the time for repairs or maintenance or anything like that. Don't get me wrong. Every single property is going to require maintenance. But if it's requiring maintenance every 6 months, the roof, and now, there's a flood. Now I've got to do the flooring, and you know what I mean? So it's just make sure that it's reasonably good quality for the budget that you have. It will only benefit you if you don't have to sell it. Okay. I know a lot of people, buyers agents in particular, might preach get into a market, growth, sell the property, get into another market. I don't know, man, because it's the cost of buying a property, the stamp, that's massive, man. The cost of selling a property for a sales agent, getting their commission, that's massive. The time then in between you selling and buying another property, that market growth you're missing out on, that's massive. So you have to really be getting some mad gains to be flipping and moving and adjusting. My advice, just buy a property and settle on it, right? Unless you want to be super aggressive, then go and do the buy and sell shit. But most people I know don't. So that's, I guess, what, in my opinion, why property kind of is a good middle ground for balancing against inflation, balancing risk, and getting the benefits of it, right? So there's some common things that we've seen that people sort of tell themselves about inflation. And it's kind of there's a couple myths I want to bust here. So people ought to think cash is safe, cash is king, right? We hear that quite a lot. And it might feel safe. In my opinion, it is safe in the short term because obviously we've got to save to do something, right? We that's a given. But if it's a long term, I'm going to save for I'm holding on to my cash for 3, 4, 5 years, man, just know that your money might be safe in the bank, but the inflation rats, they're eating away at it, right? So it is very risky long term. Some other myths is that property always wins. And the reality is it doesn't. It only wins if you can hold it. So the key is to get the right property in the right area so you as an individual can hold the property. Very important to get right. I'm getting pay rises, right? Like people think that my wage is growing, and that's great because you obviously want it to grow rather than not. But how quickly is it growing, right? Like if you've got a 10 grand pay rise, every couple of years, or whatever it might be, how is that, like, when you adjust for inflation, like what does that actually look like for you? So I don't want to sell this doom and gloom kind of picture here. Like, hopefully I haven't scared some of you. And if I have, I apologize. It's not the purpose of this episode. I don't do the shock value type of thing. So what you can do practically is a couple of things. With your investment strategy, your just kind of life finance kind of strategy, you want to plan for survivability, right? So survivability in your budget, in the amount of debt you're taking on, in the risks that you might be taking on in terms of investing and things like that. Treat cash as an optionality to go and do something with it. Don't treat cash as a strategy. Like, I think holding on to cash is one of the worst things that any company can really do. I think, as I mentioned, with debt being eroded with inflation, don't take that as a signal to just go and leverage up to your eyeballs. Like, make sure the debt's manageable for you right now and at future stages of your life. Rest assured, if we have the system and it continues to inflate over time, yes, the debt is going to be eroded with inflation, but don't feel like that's going to increase your borrowing capacity, or like, you can just hold the debt and, whatever, and then in 10 years' time, you're going to be able to wipe it out in like a month. Be sensible when taking on debt. Not financial advice. Speak to your broker. Make sure it matches you. Focus on assets that you can hold long term. Okay. If you're up to your eyeballs and it's getting really hectic and you got to sell, that's when you'll lose, right? So you want to make sure it's sustainable and manageable for you as the individual or the couple or the whatever that you're doing. Don't try to outsmart like the system, right? The system is designed the way that it is. There's not really any getting around it, right? Pay your bills, pay your taxes, repay your debts. Make sure all that is in a manageable situation for you. So you're not going to beat inflation by trying to predict it. You are going to survive inflation by structuring correctly. Okay, keep that in mind. Very important to get right. So inflation isn't a flaw in the system. It might be considered a flaw. It's there by design. Inflation is there by design, right? It's part of the system. Okay, so it is going to transfer purchasing power from people who hold money to people who hold assets. The scary part is that this is happening regardless of anything going on in the world, right? Inflation is just constantly occurring every single day, every single week, every single year. And the shitty thing is that a lot of people don't realize on what side of the fence they're actually on. So in my view, I always encourage people to obviously educate yourself as best you can with whatever it is that you're looking to do. Don't wait too long to make a decision to do the thing that you're looking to do when it relates to investing. You never want to rush, obviously, but time is costing us a lot, right? If we're just sitting there holding and waiting. If you need help building a property investing plan for yourself, you can reach out if you're on YouTube or Spotify. There is a link in the description below where you can go through, book a call with the team. It doesn't cost you a cent. Maybe 5-10 minutes. We'll have a chat with you to work out who you are. Can we help you? If we can, we'll show you how, show you the next steps, what it looks like, and then you can decide whether you want to work with us or not. That's all we have time for today's episode. I appreciate you watching and getting this far. If you got this far, I mean, you can leave a thumbs up. Come on, you can do it. That's all. Till next week, I'm Nick V. Thanks for watching. Catch you soon.